assets and liabilities and equity, oh my! If like Dorothy from The Wizard of Oz, you are feeling completely lost on how to read your balance sheet, then welcome to your financial yellow brick road. In today's video, we're gonna go over these topics in detail, and we're gonna get you to a point where you not only know how to read your balance sheet, but you're gonna be able to do it in a way that you'll be able to get your business healthier and be able to have it stay that way without needing to rely on the Wizard of Oz himself to completely demystify these topics for you. I'm James Masotti. I'm the owner of Our Team Accounting, and on this channel, I am passionate about helping entrepreneurs achieve their personal and professional goals through intentional financial planning. Now go ahead and get on your ruby red slippers, click your heels 3 times, and let's dive into today's video. The first thing that you're gonna see when you take a look at your balance sheet is going to be your assets section. And assets are the things that you own that add value to your business. Now, from a financial perspective, we tend to break these up into 2 different categories. First, we have what are called current assets, which are things that are cash equivalents, and things that can be converted into cash in the near term, which according to GAAP is 12 months. So while as a business owner, that may not feel like near term, that is the technical definition that we're gonna use for our accounting purposes. We then have our non-current assets, which are any of those longer term assets that are not gonna be converted into cash for a period of time greater than 12 months. Some of the most common examples of current assets that you're gonna have on your balance sheet are absolutely going to be your cash itself, right? So these are any bank accounts, money market accounts. The next one that is most likely on your business is going to be accounts receivable. Most businesses have some form of accounts receivable, even if it's really small, and that's going to actually sit on your balance sheet. I know it might seem counterintuitive that people owing you money is actually an asset, but that is how it is considered from an accounting perspective because these are sales for which you are expecting to be able to collect your revenue. The next one that we have is going to be inventory, and so not all businesses actually are going to be sitting on inventory. However, if you have a lot of material that you've either purchased to convert into product that you're not planning to use like right away because you're purchasing in bulk, or you do actually produce a product in bulk and then sit on inventory of that before selling it to your end customer, this is going to be reflected as an asset on your balance sheet. The next one that you may have on your business, especially if you're in any sort of retail environment, is going to be undeposited funds. So this is when you're going to receive cash and checks that aren't actually sitting in your bank account yet, but you've already reflected the revenue on your financial statements or on your income statement. And another thing that you may end up seeing on your balance sheet is going to be prepaid expenses. So a lot of times you may have an opportunity to pay in advance for any services that you're getting from one of your vendors. And if you do that in advance of those services actually being provided to you, then it's basically established that that business actually owes you money. And as a result of owing you money, no different than when your customers owe you money for services that you've provided to them, these prepaid expenses are actually an asset to your business as well and have monetary value because you're going to be receiving those services in the future without having to put out any additional funds. The next asset that we're going to be talking about from our balance sheet are those non-current, or what are sometimes called fixed assets. Probably the most common examples of fixed assets that you're likely to see on your balance sheet are vehicles, for example. A lot of businesses either have a fleet of vehicles or a delivery vehicle, or sometimes it might just even be the owner's vehicle if they use it a lot for their business needs and traveling around to see prospects and customers and things along those lines. In addition to vehicles, another very common fixed asset is going to be real estate. If you own the real estate that your business is in, or your business owns real estate nonetheless, then that's something that you're also going to see here on your fixed assets schedule. If you have any sort of machinery in your business, then this is also the section where you're going to see that. So whether you're in manufacturing or you maybe own anything like a bakery or anything along those lines, this is where you're going to have that machinery. Now, there is some IRS guidelines around what would be considered an asset when you are purchasing machinery, but there's also a conversation that you need to have with your tax professional around what some of those classifications are. A lot of times you can get away with simply having an internal company policy that says we're only going to consider something an asset if it's over a certain dollar amount. And that's a really important thing to make a distinguishing factor on, because what you don't want to have to do is consider every single mouse and pen that you buy as an asset, right? So when you have certain things that you buy for your business, you're going to consider them to be expenses because they fall below a certain threshold. So depending on your business, you might be able to buy a computer and have that be considered an expense if it's only a few $100s. But if you're, for example, maybe a video editor or something along those lines, and you're buying an extremely expensive Mac that is maybe upwards of $5,000 or $10,000 as a computer, then you may actually need to consider that as an asset and have it register on your balance sheet instead of expensing that purchase on your income statement. So another category of things that may be on your balance sheet, but is somewhat less frequently there in the majority of small businesses, would be things that are considered intangible assets. So intangible assets are going to be things like patents, trademarks, and goodwill. So if you do own any patents or trademarks and you can identify that there is specific value associated with those because you're the only one who's able to have those and they therefore add value to your business, you can put those on your balance sheet as an asset. Goodwill in particular, for example, when I acquired my business, there is a certain amount of the purchase price of the business that goes towards goodwill. And that's probably the example that is most frequently used for goodwill. Another form of intangible asset that more businesses may actually have sitting on their balance sheets is when you make software purchases. So we're not necessarily talking about your smaller, SaaS, reoccurring monthly payments of $50 here or even $150 there. What we're really talking about here is when you make large investments into large software purchases. These often come in the form of like large CRM or customer relationship management softwares, large ERP or enterprise resource planning softwares, or if you actually go and have custom software developed or custom apps built for your business, then those expenses are oftentimes needing to be captured here on the balance sheet as an asset of your business. Other potential non-current assets would be things like deferred taxes. So if you're in an opportunity zone, or if you have negotiated with your local, federal, state government for any sort of deferred tax treatment as a result of setting up your business or buying particular equipment or anything along those lines, you will want to capture those deferred taxes as assets on this section of your balance sheet as well. All right, so now that we've talked about how we're gonna be looking at the assets that our business owns, the next section of your balance sheet is gonna be where you record your liabilities. And just like we have current and non-current or fixed assets, we also have short-term and long-term liabilities. We're going to be using the same definition. So short-term liabilities are things that our business is going to need to pay sometime in the next 12 months, whereas long-term liabilities are things that we have the balances being paid off or being due in a period of time that's further out than the current next 12-month period. Probably one of the most common things that you're going to be seeing under the short-term liabilities section is going to be your credit cards. Most businesses operate with some sort of a credit card that they're using to charge their monthly expenses on. And even if you're paying that off on a regular basis, there's a very strong possibility that your billing cycle doesn't line up with the end of the month. And so you're always going to kind of capture some sort of a balance sitting on that credit card that has a due date very near in the future. Another one that is very frequent for businesses is accounts payable. So if you have any suppliers that you don't pay immediately for things or pay in advance for services, there's a pretty good chance that you're on some sort of like net 15, net 30, net 45, if you're lucky, net 60 or net 90-day terms. And so you need to capture those liabilities of the fact that you owe those vendors money in that time horizon, basically. The next one is going to be any loans that you have where the maturity date on those is coming up in the next 12 months. So these could be loans that either started with a period of amortization of less than 12 months, or they could be loans that originally had repayment periods greater than 12 months, but only have 12 months or less remaining on them, have been moved from the long-term liabilities into the short-term liability category. This next one is actually a topic that trips up a lot of business owners, and that is the concept of deposits and unearned income. So deposits and unearned income is one of the areas where we see business owners make the mistake a lot of immediately contributing that to revenue, when in fact the cash does go into your bank account and therefore it is an asset. It's not yet revenue because you have not yet delivered and performed those services. As a result, because you haven't earned that, it's technically a liability that you still owe it to that client, that customer, to provide them that service. And so when you receive those deposits, you actually have to record those as liabilities that you owe to those clients in the near term. And so it's very important to understand that when you get those deposits, one, you want to be really careful you don't spend that money. We certainly see that happen a lot with businesses where they take deposits from one customer and they use it to actually cover expenses from another. So if you're doing that, don't. Little quick tip inserted in here. But you definitely want to make sure that if you're getting those, you are recording those liabilities. And then once you do recognize the revenue for doing the work, you move those liabilities to revenue. If your business is on accrual accounting, or if you have more complex payment structure, there's also a possibility that you may need to accrue payroll and paid time off on your balance sheet. If you are doing accrual accounting, especially as your business grows larger, you probably will be doing that. You're going to come to the end of a month where you're going to be straddling payroll periods, and you'll technically need to have a payroll liability on your balance sheet for the work that your team members have performed for you, but you have not yet paid them for those services until the upcoming payday. If you aren't doing month-end closes where you need to be reporting your financials and you're kind of just letting that stuff roll over, but you do need to provide any sort of annual reports for those things, then you may have to accumulate both the PTO for your team in terms of any paid time off that they have accumulated and you therefore need to pay them, as well as any wages that they may have earned towards the end of the year that straddle a pay period that doesn't actually occur until January. If you're on a cash basis, I would recommend having a conversation again with your tax professional to see if this distinction is something that your in-house accounting team or your outsourced bookkeepers need to be keeping track of. But you should also be aware of your state regulations. If your state requires that you pay out accumulated paid time off, then it's a pretty good practice to make sure that you do have not only a accrued liability on your balance sheet, but also that you have the money set aside in a separate bank account so that you make sure you're always in a position to be able to cover that liability and you don't end up in any sort of potential legal trouble, even though from an accounting perspective, you wouldn't necessarily need to do any of that. Another liability that you may need to reflect on your balance sheet is going to be taxes that are owed. So a lot of businesses are responsible for collecting taxes based on their work that they do or for their employees, but they only have to remit that tax on a quarterly or semi-annual or even maybe annual basis. If that's the case, this is another example where you really don't want to mess with the tax authorities. They can do all kinds of really fun things to your business. And hopefully you understand the immense amount of sarcasm I just put into that. And I encourage you to make sure that you are creating a liability accrued on your balance sheet, even if you're not doing accrual accounting. And I also strongly recommend that you have separate bank accounts set up where that money gets moved into so that you know with 100% certainty that that money is not yours and that it matches every single month with the liability that you've accumulated. So if at any point in time you get audited by any of the tax authorities that you have to pay, you can very clearly document all of the transactions, where the money sat, and how that money matches up what you paid to the liabilities that you accumulated. If you've ever been audited, you'll know that this would have made your life amazingly more peaceful during a stressful time. If you have not yet been audited, please just go ahead and Google a little bit, and hopefully what you see scares you enough that you want to go ahead and set up this best practice. The next form of liability that you could have on your balance sheet is one that may not be pertinent to your business at all times, but it is important to understand this concept of contingent liabilities. And what a contingent liability is one where you may or may not have to pay it based on certain things that may or may not occur in the future. And one of the examples for this would be a lawsuit. If a lawsuit gets filed against you, there is a chance that you may have to pay out a liability if you are found to be guilty or in violation by a court or by an arbiter or something along those lines. You may also choose to try to settle that case out of court, in which case you'll want to start accruing a liability for the potential that you'll have to pay that on a contingent basis. If you happen to be in a business where you experience damages or where you offer a warranty to your clients, then there's also a pretty good chance that you know what your defect rates are, and you know how frequently that you are having to make good on those warranties or how often your product is being damaged. And so those are also liabilities that are contingent on whether that does or doesn't happen. And it also will depend on the time horizon. And so these are all things that we're expecting, because they're being reflected in our current liabilities or short-term liabilities, are going to happen in the next 12 months. Another potential liability that you'll see on definitely publicly traded financial statements, but again, a lot less common in the small business world, would be any dividends that are payable. So if you have declared a dividend that's going to be paid out at some point in the future, then you would need to start accumulating funds as a liability to make sure that you can pay that dividend out to your shareholders. Whether you're new to business or you're looking at what I've got on screen and thinking to yourself, man, that looks nothing like my chart of accounts, but I wish it did. Well, there's good news. You're in luck, because we've got a free template chart of accounts that we've put together that you can download and use as a reference for building your own chart of accounts, adding in things that are missing, subtracting out things that you don't need. But if you go ahead and scan the QR code that's on your screen or click the link in the description, you'll be able to download this free resource that we've made for you. All right, so now that we have gone over our short-term liabilities and you have gone ahead and downloaded that sample chart of accounts, we're going to talk about our long-term liabilities. The thing that's probably most often captured under this section is absolutely any loans that you have payable. Oftentimes they have many months or even years in terms of their repayment plans. And so this is the spot where you're going to capture those loan balances. It is important to note here, when you are looking at your loan payments, that there are typically two actual parts to your loan payments. The first part is your principal payment, and that's the part that's going to be reflected here on your balance sheet as you pay down the balance on that loan. The second part of your payment is the interest portion of your payment. And this is considered to be a business expense, and that's going to show up on your income statement. So when you have a loan payment that is coming through your bank feed, it is important to understand that that does need to be split out into your principal and interest payments, and that those two things actually show up on two different financial statements. Two other things that could show up on your long-term liabilities would also be any of those contingent liabilities that we talked about on the short-term section, but these may be on the longer-term horizon. So if a lawsuit files, but it's not expected to settle for several, beyond a year, you could still start reflecting that here on your balance sheet. Or if you have any deferred taxes and things along those lines where, you will eventually have to pay those in the future, but that's further than a year out, that would also be captured here under that section. So now that we've gone over the different types of liabilities, we're going to talk about the final section of the balance sheet, which is the equity section. So one of the first things that you're going to see under the equity section of your balance sheet is going to be your retained earnings. And retained earnings is a fancy term that basically says that it's money that in previous years would have been reflected on your income statement as net income, but that income was kept in the business and it was not distributed out to the equity holders of the business. It's basically like the cash is either still sitting in your bank account or it was somehow being reinvested back into the business. And because of that, this has retained value, and that's why we call it the retained earnings. And so that's kind of a rollover element of the next thing that you will see on your balance sheet, which is your net income. So the net income comes onto your balance sheet directly from your income statement. And so as you go throughout the year, whatever net income level you have in your business is going to be basically copied over and duplicated directly here on your balance sheet for the current year. As you close out the year, then that net income is going to roll over into retained earnings, either adding to or subtracting from, hopefully always adding to because you're running a profitable business, but you could have years where it is negative net income and you subtract that from your retained earnings. The next section of equity is going to be any owner's contributions to the business. So most likely when you started your business, you had to inject some capital or some, you paid for things and stuff along those lines. And this is where you're going to reflect the amount of money that you or any of the other owners have put into the business. You would have a corresponding matching example if you had any, again, this is where any equity holders. So when we say the business owner, if you have any minority investors as well, this is where their investments of capital would be reflected on your balance sheet. On the flip side of that, once you start having enough surplus cash flow that you can start taking distributions, you'll also reflect that here in the equity portion of your balance sheet. And that's where you're going to be taking money from either that you invested into the business and pulling that back out, or once you get to the point where you actually start pulling more money out than what you invested in, you'll be taking that out of your retained earnings. So some additional things that could possibly be on your balance sheet pertain to the issuance and the buyback of stock. And so if your company doesn't have stock, then these are not going to be relevant for your business. But if you are a business where you issue stock to your investors because you're set up as a corporation, or if you're looking at the financial statements for publicly traded companies, then you're going to potentially see additional paid in capital, or you're going to see treasury stock on the balance sheet as well. And the treasury stock is going to represent the stock that the business has purchased back from investors. And the additional paid in capital is going to represent any additional funds that the investors have contributed that is above the value of the stock that they have purchased. Don't worry about these terms being super technical. Again, if you get to the point where you're looking at balance sheets where you need that level of detail, then you're either looking at somebody else's, or your business is probably large enough where you can hire somebody to make sure all of that stuff makes sense to the people who it's most important to. So now that we've run through all of the lines on your balance sheet, it's going to be really important to understand how the combination of your income statement and your balance sheet actually reflects the cash moving in and out of your business. So go ahead and click on this video here, where we're going to now dive into the cash flow statement, and you'll make sure that you keep oxygen in your business to fight another day. I'll see you over there.